auto ancillary, I'm very, very, very optimistic. See, there's a very large change, Raj, which is happening here. The move towards electronics. Okay. Here, whenever there's a large technology change, a big pivots can happen of profit pools. And this is where I would say that anyone should focus on, because if India becomes a hub, you're looking at about 15-20 crore vehicles getting replaced, right? There's a very large change happening here.
Hello, listeners. My name is Raj Singhal, and welcome to another episode of Breaking Investment Stereotypes. Here we deconstruct world-class investors or wealth managers and deep dive into their investing journey, professionally, personally, or both. This episode is brought to you by Multiply.co, where we believe that investing is an ignored life skill. Our mission is to create a platform where people can find fellow investors, discover investing products, and share investing ideas. We have now gone live and thousands of users are already part of a vibrant community. So do check out our app, which is there both on Apple Store and Play Store, or simply just sign up on web. I want to give a little guidance on how to use the shows. None of the following should be taken as an investment advice. Please see multiply.co/disclosures for more information.
My guest for today is Amit Jeswani, who's founder and CIO of Stallion Asset Management. Amit is a double charter, and he has successfully completed his CFA from USA and Chartered Market Technician certification as well. A graduate in business with finance from Kingston University, London, Amit has been investing in the capital market from the last 13 years. He started at a very tender age of 16 alongside his father, who was a stockbroker. With humble beginnings, he started Stallion Asset as a research analyst firm, and with the trust of his clients, Stallion Asset has scaled up to become a portfolio management service firm. So without further ado, please welcome Amit Jeswani. Hey Amit, welcome to the show.
Hi Raj, thank you so much for having me on your show. Thank you.
Oh, thanks. So Amit, we'll start with your life journey. Tell us, how did you decide to get into full-time investing and fund management? I was just hearing one of your talk where you mentioned that you actually started investing way early with your dad. So tell us more about that.
So my father was a stockbroker. Honestly, I don't know anything else. That's why I'm in the stock market. Like my father was a broker, and he didn't know so much computers, right? And as kids, I was very passionate about money always. And that's how I started. We were brokers. There used to be like 20, 25, 30 clients. So that time there used to be your dealers, and behind your dealers, there would be traders sitting there. So I used to learn a lot from what others are doing, how they're leveraging. I used to see a lot of technical analysis that time. Of course, now it's more active, I would say. So that's how I started. And I used to learn from other people's mistakes, because when you have a few thousand clients, you get understanding. So that's how I started. Of course, I used to also trade the market, win money, lose money, a combination of both. But that initial part gave me a lot of insights on risk management, especially on how to pick stocks, how to catch trends. That helped me a lot. Then I went to London for my studies. Yes, so that's how it basically started. I was pretty young that time, but very, very passionate about the markets that time also.
So, as we say, there is always we always, of course, make mistakes when we start, right? So what was your first biggest mistake you made while investing?
I was leveraged to, I made probably at an age of 15, 16, it was 2006. So I was probably 17 years old that time. So I made my 3-4 lakhs into 1.25 crores.
Wow.
I became
a lot of money for a 17-year-old kid.
So that was my initial part. So I was very aggressive trader. I would say I was leveraged. And that time, 2007 was a year where I believe a lot of people made a lot of money, right? Trends were very clear. You would buy an RNRL, an RPL, an ISPAT, and next day these stocks would be up 5-7%. There was a lot of traders in the office. So and what we had was, so over time we realized that everyone wants to move towards technical analysis. So what we did is we gave a Falcon software. That time the only technical analysis software was Falcon that was provided. So we bought like 15-20 Falcon softwares, and that time these softwares costed a lot, and everyone would trade the markets on their own. So basically we made every customer, and that time it was like a revolutionary thing. But I used to learn a lot, and I used to be with the trend. So I did understand about I didn't read a lot of books that time, but I did understand how to be with the trend, how to manage your risk. But 2008, I would say, was very, very, very tough. 2009, I lost my confidence. And in markets, it's okay to lose your capital, but you cannot lose your confidence. And you could not, like, I couldn't trade. Okay, it was getting so, and I was in London that time, but it got very difficult to trade the markets, because even if I would make, let's say, 30, 40, 50,000 on a trade, I would exit my winner, and not that ability to ride a bull market was basically gone, because my confidence was gone. And then I moved more towards academics. I got a few internships at some investment banks in London on the trading desk. I saw how they used to trade the markets, how they would win basically in markets on very large sums of money, right? A few $1 billion. But I was always passionate about moving back to India because I saw India as like a massive growth opportunity. My father was investing in real estate also. And that time, prices of real estate would go up 40% CAGR, 30% CAGR at least every year. So I would see what kind of capital my cousins are making. And I had that thing for India. So I knew that I'm going to go back and basically go back in India. And that's what I did. I came back to India. I did my CFA that time. I did my CMT. 2009-10, I would say I was bruised, but I was not out of the game, right? I stayed in the game because, of course, I didn't know anything else, right? If you've spent 5-6 years and you've just been doing that, yes. So that was how I started, I would say. I was then working for a few, one of the largest brokerage houses, some banks in India. So that's how then more on the trading side always. So till 2011, I would say 2011-12, I was not supposed to be an investor. My whole goal was, how do I be a better trader?
So what made you change from being a trader to an investor, right? Because now you are a growth investor. That's what I see.
So it was about, I would say that I was doing my CFA that time. Of course, I did get a very strong understanding of fundamentals. But trading, what happened was that the firm that I was working in went bankrupt. Okay, and they were the largest brokers in the world. And they because they were long Greece bonds, and Greece bonds went bankrupt. And that's why I had to move out from there because your limits, you know how the trading world works, your limits go down, you're not allowed. So if your limits go down, your bonuses go down, you can't take very high positions. And that time I was doing my CFA. And when I got a job in a hedge fund, and once I got a job on the hedge fund side, I did, and the focus, see, Raj, according to me, there's no large difference between technicals or fundamentals. We're all looking at patterns, right? Warren Buffett looks at a pattern, right? He looks at moats, growth, pricing power, etc., etc. Even Paul Tudor Jones, who's a trader, he looks at his own patterns. Ed Sekiota looks at patterns, right? Even when you go back, way back 80 years, you'll see all value investors were focused on a pattern, right? They're focused on dividend yields, trading at less than book value. So whenever you find investors, you see that every investor basically focused on a pattern of investing. And for me, like when I joined my firm, like the new firm, on the fundamental side. That time I was looking at the tech side for them, and tech that time was very, I would not say it was booming because it was just getting started. We would just hear words like smack and that time, like social, mobile, analytics, cloud, and those things were very, very, very new. But I made very decent money even there, just following the pattern. Like, this is what works. So you need to, at the end of the day, we need to perform in the market. The idea is not becoming just being knowledgeable. The idea is to get rich as well. So you need to connect the fundamentals or the patterns, and we still do that with the stock price, that this pattern works and this pattern will not work. So, and there were trends, right? So, and there are trends in the market. Like Dow theory would tell you there are 3 trends: primary, secondary, minor, right? The minor trends are basically very random in nature, the short-term trends. But we have traded all 3. Like, I have personally invested in all 3, my time in all 3 of them, and seen how to basically win all these 3 things. So, but largest wealth, I would say, is made if you can get the long-term trends right. So if you can get trends for 5, 7, 8, 10 years, that's where you can make, with a large location, you can make a very decent size capital.
Yeah. I mean, with short term, you can make 10, 20% or 30%. With long term, you can actually multiply your wealth multifold, right? You talked about trend, and I want to deep dive into those primary, secondary, and the short term trends. Can you elaborate more in terms of what the trends you're seeing now before I dwell more into your investing philosophy?
So India, I would say there is a very large trend towards consumption, and this story is going to stay for the next decade, 2 decades. Our per capita is $2,000, right? India's total profit pool is 6.5 lakh crores. Consumer companies, the largest profit-making consumer company in India is probably an ITC with 14,000 crores of profit. Then comes your HUL at 9,000 crores. Then you have Nestle at 2,000 crores. These are very small numbers. Consumer as a basket, the total profit pool is 44,000 crores. Out of, so Nifty 500 profit pools is 6.5 lakh crores. Consumer is 44,000 crores out of that. So consumer as a portion of the total profit pool is only 8% as of today. If you look at tech, I believe that will have, so as I said, the total profit pool of tech in India is 91,000 crores. Out of that, TCS is 34,000 crores, Infosys is 22,000 crores, HCL is 11,000 crores, Wipro is 11,000 crores. Then you have your LTI at 2,000 crores. Then you go, basically the profit pools for every industry over time get concentrated in a few players. And that is in US, that's in India. The market leaders typically make it large. So once you get a very large opportunity size and you get a very structural trend, and especially, so this is what I believe, what you want is, so there are 4 kinds of businesses. The most important is a shark in an ocean, where you are a market leader in a very large opportunity size, right? If you get a company, so every industry in India broadly grows at between 10% to 13-14%. If you can get a company which grows at 2 times, 3 times faster than the industry for a very, very long period of time. So example, we will not buy a Maruti who's got 55% market share, right? Because it cannot grow faster than the industry. We want to buy companies which are 1, 2, 3, 4% market share. I would call it the hungry sharks in the ocean, and grow for many, many, many years way faster than the industry. And that's where you can get long-term trends. So you make a basket of companies where you believe you can get secular, sustainable, durable growth, and you just make sure that you're in the right stocks in that basket.
So that's a long-term trend. What are the other trends you're seeing? So you spoke about consumption as a long-term trend. What are the other trends you're seeing?
Consumer, technology, financials. So these are, okay, I would say, very strong trends in India right now. The 4 trends which are just developing, but when trends are in stage 1, that's where big money can be made. I would say an export. So India has been an export economy. So out of our $600 billion of total exports, $200 billion is services, which should move to at least $400 billion this decade, right? Manufacturing, so China's total exports is $2.5 trillion. That's what China exports. I believe there are some places where India is getting competitive advantages, something like an automobile, like these PLI schemes will be a big game changer, which can create multi-decade. So every large trend starts with a change, right? PLI itself, I believe we have to look at, so we just have one stock in our portfolio, more on the electronics side for PLI, but this Make in India story or the export kind of themes can deliver 20-30% kind of growth for a very, very long period of time. So you need to be with the trend wherever you see earnings growth higher than the index. So last decade, example, Nifty earnings growth was 2%, but you had your consumer companies which would grow at 15%, some at 20%. They created wealth. So I expect Nifty earnings growth to be 10-12% next one decade as well. So I expect Nifty 500 profit pools to move from 6.5 lakh crores in FY21 to at least 17 lakh crores in the next 10 years. So there's 11.5 lakh crore profit pool to be attacked. Now, the question we have to ask, who are the players who will get it large? And they need to be leaders with you, or they need to continuously pivot like Reliance. Reliance is a pivoter. He pivots from one opportunity to another. So, but technology, as I said, is 13-14% of India's profit pool. This number should move towards 40-45%. And so will the market cap, because that is what has happened in China. That is what has happened in the US. Tech is now about 50% of market share, even after the collapse that we've seen in hyperscalers in the US. So yes, so we look at hyperscalers and we also have the proven monopoly. So our baskets are the proven monopolies basket, which helps us in bad times. But we also look at hyperscalers, companies which can grow at 25, 30, 40% for a very long period of time, but they need to be market leaders. So we don't buy the not so good quality companies. So there are 4 kinds of risk, Raj, that you always have to take in markets. This is what we believe. One is business risk, where the business is very cyclical, right? We try to avoid that. We don't have cyclicals in our business. The second kind of risk is taking management risk, where the management, so there are 2 kinds of managements. One who's unethical. For an unethical management, the fair value is 0. The second side is where the management is not capable. Okay, very less things are spoken about not being with capability of the management, right? We also look at his track record of scale ups, the ability to pivot. We like managements who can scale up faster, right? Because entrepreneurship in India is a 100-year-old thing. Hyperscaling in India is 10 years old, right? So we are just at the starting point, I would say, of hyperscaling. The third kind of risk in Indian or any stock market is industry risk, where you flirt around with businesses which have exposure to, let's say, government, right? Where receivables will never come only, right? And you make massive drawdowns in B2G businesses. So we try to avoid those kind of businesses. Not that we've not lost money there, but we've learned all these from our own mistakes. Over last decade, 1.5 decade, I would have done hundreds of mistakes, but you keep learning from your mistakes and try to get better. And the fourth kind of risk is valuation risk, right? So business risk, valuation risk, industry risk, and management risk. These are 4 risks, and believe me, whenever you're investing in the markets, you'll have to take one of them for sure. So valuation risk is also a challenge in India, especially where now once everyone knows the story, the compounding becomes lesser. Yeah, but we do take, I would say, valuation risk if we believe in the long-term structural story of the companies that we invest in.
So, Amit, you mentioned about monopolies, and I think you've published a note called Analyzing the Winners. So can you share more details around the learnings and the findings in that?
So eventually profit pools for every industry get consolidated to one or two players, right? You need to find companies who can get that profit pool. First, how big is that opportunity and who will get that profit pool? Example, if it's the beauty market, right? It's a 1.1 lakh crore market growing at 14% in India. You need to see who's going to get that market. Do customers love the product? For every industry, there's a size, and you need to see who's going to get that, because all companies, all industries, the profit pools typically get consolidated into those 1-2 players for every industry. So you need to make sure that you're owning the Apple and you're not owning basically the Xiaomi's of the world. So Xiaomi is probably a market leader in the low cost side, but the largest wealth creation will happen in monopolies, and you will also not face drawdowns. So you get higher growth, higher ROIC. You probably end up paying some higher valuation at start. But when you look at this 3 years from today, the growth, if it's a market leader, it needs to grow faster than the market. Only then it makes sense, right? I don't want a market leader which is growing at 8% and a competitor like other players are growing at 12, 13%. That would not make a lot of sense. The market leader needs to grow faster, create moats, and get better with size. And the industries that we invest in, let's say financials, right? I'm just giving you an example. Why would anyone open an account with smaller banks and not be with the large player who's got 4,000 branches, who can give him loans at lower cost? You can transact, there is a higher level of trust. So there are some industries where you get better with size, like consumer FMCG, right? You can just, if any product becomes 100, 200 crores of revenues, all HUL has to do, and this product, let's say, is selling to 5 lakh retailers. All HUL has to do is buy this product out or replicate this kind of product. I'm just giving you an example. We don't own HUL in our portfolio. So it just has to buy that product out and or create a replica and sell it across 1 crore retailers that they have. So in some industries, the bigger you get, the better you get. You get better in financials, I believe. You get better in technology. Most of the times, you get better in financials, technology, and consumer. Yes. So these 3 areas, you get better with size. You don't get worse with size. Like Google doesn't get worse with size, right? It only gets better. It integrates more and more things to your entire portfolio basket. So yes, in these 3 industries you get but there are some industries where you don't get better with size. You don't get better at size in steel. You don't typically get better at size at aviation, because you'll have to fly the unprofitable routes, right? If you are 50-60% market share, you already have the Bombay Delhi with you, right? Now you'll have to do Pune, Raipur, right? Those kind of routes to get that excess profitability. So there are some industries where you typically get, and that's where you can, big is better. It becomes a story. So yes.
Okay. I think I recently saw your tweet talked about the FI money is dumb money. You know, they've sold like $25 billion in 22 and probably turning to a buyer now. What do you make out of such a large scale selling by FIs? And of course, you know, the domestic institutions have stepped in. And thanks to all the mutual fund SIP flows for that. So
Raj, I'm surprised, to be honest, and I'm happily surprised, right? I'm not sadly surprised. We are long only, we're always invested in the market. But I'm very happily surprised that Indian retail has been able to suck in this kind of selling. But also, I would say that never fight the Fed beyond a point. Because there are 3 ways of learning the market. Learning about 50, 60 years of market cycles. That's the first way. The second way is learning about individuals and people who've made it large in the markets. Like, I don't want to speak about authors but I'm speaking about portfolio managers and people who've literally invested in the market and made it large in the market. That's where you'll get. And third is to learn about what patterns work. Look at your own like 5 years, 7 years of data of markets. Your own data and your own trading patterns, factors basically, that high ROE works, growth works. What are the factors that work? Once you study these 3 things, you become you get a very decent understanding. So the money which has gone out of India, is not passive money. We all know who's been selling. BlackRock's been very aggressive. They lost about 150 billion in Russia. So the guys who are selling, some is forced selling, I would say, and some and the quality of stocks also which are moving higher tells you that you are at a late stage rally, right? You are at a point where you are at a very late stages. Some story stocks, some dream stocks, the kind of stocks that you would have in your moonshot portfolio. Those are the kind of stocks which are definitely moving higher. So the qualities become weaker and not stronger, at least in the last 2 months, I would say, last 1 month, 1.5, 2 months. The quality of the stocks which are rallying is a late stage rally.
Okay.
Yeah. So it's not the dumb money which is moving out of the, not all is dumb money, I would say.
Okay. So what will be the signal? So are you turning a little bit cautious here? I mean, you spoke about the whole Fed thing, and we all are aware that Fed is going to aggressively hike now and also start tightening. So how are you positioning your portfolio?
So actually on the 15th so pivot days become bottoms. So even on my Twitter on 15th of March, I had tweeted that, what a big pivot is coming in the markets, right? And that was for global markets. And that exact day was the pivot bottom. So markets typically bottom out on an event, right? Be it the day demonetization happened, right? Markets bottomed on that day. That was the same day what Donald Trump got elected. Let's take lockdowns across the world. Lockdowns were around the 22nd and 23rd of March. And that same day, markets were falling before that. And those pivot days, markets bottom and just start moving against the news. This time also around the 15th of March, that was the time when the first Fed hike was going to get announced. And so if you look at 2008 as well, if this is a normal understanding of the market. So markets were falling till June of 2008. That is where Bear Stearns went bankrupt. And when Lehman went bankrupt, that's where the last drawdown happened. So markets typically bottom on the worst news. So the news what everyone was awaiting was the Fed hike. Till the markets have stopped reacting to the Fed rate hikes lately. In the Indian market, I'm speaking about, the global Nasdaq has still started correcting. But overall, I don't think I'm so capable of continuously being able to predict the direction of the market. But I wouldn't go blazing out and saying that, I'll have 80% of my portfolio in small caps and I want to be massive risk on. So I'm not very bearish on the markets, but if the 10-year bond yield goes above 3%, you will have a new knock, I would say. So if a 10-year bond yield moves about 10%, high probability you'll have one more knock. And it's the celebrated stocks. So the patterns repeat again and again in the markets, that every celebrity investor strategy between 2014 to 2017, assuming, was a celebrated investor strategy, was chor bane more. And that got hit very badly, I would say, in 2018.
I love that line. I'm hearing for the first time, chor bane more.
So that was the strategy. In 2020, if you look at the global market, right, ARK AUM went from $1.5-2 billion to $50 billion, coming on TV again and again. It's the same thing. And I saw that in 2014 also. With the new thing, it's because that is about the Indian markets. The same thing, there's one celebrated investor, and these things happen every 3-4 years, and that's how markets are. And you need to make sure that you're not over invested towards the so-called the Pied Piper of that bull market. Yeah, you have to be with the Pied Piper till the time the Pied Piper doesn't work. So that's how you
yeah. So I mean, Indian economy growing whatever the decent pace it's been growing, and it'll continue to grow. And of course, the per capita income will also continue to grow along with that, right? So your $2,000 per capita income will go up to 3,000, 4,000, 5,000. What do you think? And there are always inflection points related to per capita income. We have seen worldwide, right? I mean, and possibly the biggest inflection point comes when the per capita income reaches, say, $5,000. What industry you think, is going to benefit from this whole growth trajectory? You mentioned about the consumption, but I just want to go a little bit more deeper.
So consumer, I'm not very gung-ho about FMCG. Okay. Consumer, I love retail, because retail is where you get very high growth. So from grocery retail, you've got only one profitable player. He's reinvesting very aggressively there. We also have beauty retail. Okay. That's a technology player as well. But that beauty retailer is also pivoting very aggressively to fashion retail, which is a very large opportunity size. So we've got one celebration retail company also in the portfolio, right? So we love companies. So that celebration retail company has ROCs of 70-80%, but it grows like a retailer with 20% growth. We don't like 70-80%, 100% ROC and 10% growth. We like 20-25% growth and very high ROIC. So growth gives you returns, ROIC saves you in bad times, and market leadership guarantees that your money will come back. So once, and a good ethical promoter who can execute in all periods of time. So we focus a lot on how a company is executing. We also have, so you will not create, you don't have to buy the third best companies to create a lot of wealth. You can buy good companies and still create your 25, 28, 30, whatever, like we target 18-25% compounding for a decade as a fund, but decent investors will do even higher. Being in good companies, you don't have to go to bad companies. You just have to make sure, but the markets also need to agree with you. So Raj, I'm a strong believer of trends. Okay. If my stocks earnings are there, if the company is good, it should show on your stock price action also. If the stock is not hitting new highs, whatever I say and think is on one side, but at the end of the day, the stock should also hit new high. It's a market's way of saying that it's agreeing to your thesis. So I do speak about market leadership, market opportunity, management, margin of safety. What I speak less about is also momentum. Right? We are not very short-term momentum, stop loss, this, that, but we want our stocks to hit lifetime highs beyond the point for 6, 8, 9 months. If we think that the stock's not hitting new highs, we do cut down our positions because we are strong. Our focus is on capital allocation, right? We cannot be on, and all investors, when they come to us, they come with a 10-year horizon, but every investor looks at its portfolio at 3:30 p.m. daily. so
if not multiple times during the day.
So we have to make sure we are overall outperforming the market. So that's our job. That's what I believe. And both sides, on the downside and the upside. So that is our whole goal. So the stocks need to make. You can wait for 6 months, 9 months, like 15, 20, 30% of your portfolio will always not be hitting. So we are in consumer, financial technology, and pharma. Typically, when consumers are doing well, that is a risk-off rally. Financials are not doing so well, right? So we get an opportunity to, do the reverse also, the secondary trend, which I spoke about. So let's take an example of 2 companies. I'm just giving an example. Okay. These are not recommendations. We might have vested interest. I'll give you an example. DMart and Bajaj Finance. Okay. I'm just giving you as an example. Let's take an example of 2019 September. DMart was at 3,000. Bajaj Finance was at 3,000. This is about 2019 September. Bajaj Finance was at 3,000. DMart was at 1,700, 1,800 rupees. Both companies grow at 25-30% and both have very high ROICs of 25%. Ideally, both are reinvesting 100% of cash flows at 25% ROIC. They should give the same returns. DMart, so Bajaj Finance that time would basically CAGR. I have 8% weight in Bajaj Finance, 8% weight in DMart, right? Bajaj Finance would basically CAGR at 10% CAGR a month. Okay, it moved from 3,000 to 33, 36, 39, 44, 49. Okay, it became 11% of our portfolio, right? and DMart was staying at 1700 levels, right? All we did, we sold our Bajaj Finance and took, because DMart weight, Bajaj Finance weight becomes 11%, and DMart weights becomes 6% of the portfolio, just by the same logic, right?
Yeah.
All we do, we invest that Bajaj Finance money, and this is the secondary trend, which I spoke about primary long-term trend, and this is the secondary part. We cut down weights in Bajaj Finance back to 8%, and we invest that money in a DMart, right? COVID happened. Okay. At one point, since COVID happened, DMart moved from 1700 to 2500 because it's a risk off, right? It's consumer, high inflation, low inflation. These have no impact on a DMart's long-term profitability. DMart moved to 2500. Bajaj Finance also moved to 1800 was the bottom, but 25. At one point, both of them were at the same rate, the same price. DMart became 11%, 12% of our portfolio. Bajaj Finance. So this is where you go little secondary also. So you have a primary trend, and then you have the secondary trend where you have few growth sectors and few like the defensive part. So that's how our portfolio beta since inception has been 0.83. So that's our against Nifty 500. So our beta is actually 17% lower than the benchmark, and against Nifty 50 it's 0.77. So you're playing a primary, you're playing also the secondary.
Can you explain for our listeners, this whole beta thing when you're saying 0.83, the 17% lower, just help us understand in layman language, what does it mean?
So beta is basically volatility of the portfolio against the benchmark. The benchmark, of course, 500 companies. It's very difficult to have if the benchmark goes up 10%, theoretically, or if it goes down 10%, theoretically, my portfolio should go down 8.3%. But that's where the outperformance comes. So if you take high risk and you generate high returns, it's great. Okay. But you took a lot of more risk. Our goal is not to take higher risk, yet generate more returns. So risk in very layman language is volatility of the portfolio against a benchmark.
Let's dwell a little bit deeper into the PLI, right? I mean, so the PLI schemes have been announced and supposed to be doing very well. I think what about 2 lakh crores has been announced across sectors. What are the top 2-3 segments you are most excited about and you're looking for from the investment perspective?
So I'm looking at auto ancillary. I'm looking at electronics, where India has a very strong advantage. Pharmaceuticals, we've not been able to get a strong understanding who's going to win here. But auto ancillary, I'm very, very, very optimistic. See, there's a very large change, Raj, which is happening here. The move towards electronics. Okay. Here, whenever there's a large technology change, a big pivots can happen of profit pools. And this is where I would say that anyone should focus on, because if India becomes a hub, you're looking at about 15-20 crore vehicles getting replaced, right? There's a very large change happening here. A lot of people are focused on ethanol. A lot of people are focused on even gas cylinders, right? There are stocks which are market leaders in providing CNG connections, right? 60% market share of CNG gas connections. But I would say looking at Tesla, right? Tesla now at trillion plus. The markets are very, very, very convinced about the longevity of electronics in India. So we don't have stocks in the EV space right now. But we are looking at that space because that change is a very, very large change. And that's a structural change. And you need to see who monopolizes that change. So we don't have, let's say there are manufacturers, like there's an Electra, there's a JBM Auto, but we're not 100% sure they'll be market leaders or not, right? And right now they are more on the B2G side.
Yeah.
Once we get, because they're all giving it to the government for BST buses and state buses. We want B2C facing market leaders which can basically nail it for us. Or even B2B, if you create a Bosch, like Bosch was 70-80% market share of diesel engines in India, right? Where everyone else would focus on making the components like the full bus or the components, And this guy would make the diesel engines for the entire. And if you get that for the electronic car manufacturers, large money can be made. So electronic cars, auto ancillary, and even electronic manufacturing like mobile phone, that's a more easier thing, because that is more of make for India. And you've got a very good player here who knows how to execute, right? And the ability to pivot from one business model to another is tremendous. You'll see all great businesses like Apple. Apple was 95% into computers, right?
Yep.
Today, Apple is less than 10% in computers, right? That's an ability to pivot. Google search was the only source of revenue. This quarter, YouTube was $8.5 billion, right?
Yep.
So of revenue.
Same as Netflix revenue. Yeah.
Exactly. So you're looking at companies, the great companies like Pidilite today. The last 10 years, the stock has done well, but the adhesive business has grown at 4%. They've made a fortune in the construction chemical business, right? So good companies pivot from, like Astral pivoted from CPVC to adhesives. So you need to see who are the guys who are able to pivot. Like in the electronic manufacturing the guy started from LED lights, moved to TVs. In LED lights, they have 50% market share. In TVs, they are 35% market share. Moved to washing machines, they are now 35% market share. And now to mobile. And they also started making screens for laptops. So you need these kind of entrepreneurs who say that, you know what, I'll be a shark in an ocean A, but the cash flows that I generate from A, I will invest in B, C, D. So that's where you can grow way faster than the industry.
So, we've seen a lot of IPOs, tech IPOs, which came in the last, 5-6 months. And of course, most of them have seen a decent correction. Any names among them you think has got a long-term superior competitive advantage?
See, I'll say that online insurance penetration in India. So see, what we say today may not be relevant. So all my views are till today itself.
Yeah.
Like, I would say when market opens back on Monday, my views have no
that's a trader speaking. Huh?
So yeah. I would say that, let's say you want market leaders. Like insurance, you've got one player, the online. So insurance market in life insurance is 6 lakh crores. General insurance is 2 lakh crores in India. Broadly, they are expected to double in next 5 years. So 8 lakh crores moves to 16 lakh crores. You've got one player online who does 7,000 crores of premiums, right? And he's 94% market share. I'm definitely sure that this. So in China, the insurer out there, the leading player out there is 6% market share. In Indonesia, the leading player there is 19% market share. The digital lender, digital insurer.
Insurance, yeah.
In UK, the leading player is 13% of the market. So if you just say that, 6% will happen in next 10 years, okay? So you're looking at somewhere close to a 60% CAGR growth. And there will be J curves in these kind of businesses. So these are not recommendations, and these can be very small tracking quantities for us, right? But we want to see how these companies evolve. We also like the beauty segment here. So these are companies we like, and it is very wrong way of saying that. Like this is what I think. I can be wrong. Okay, that loss hai to we will not buy. These loss. So any company which does capex, okay, if I take it up to the P&L statement, it will show you large losses. What we want is free cash flows at some point, the magnitude of free cash flows. So we all bet on the magnitude on free cash flow a business can generate. If we believe, and your take rate on insurance is 13%. So assuming you sell 7,200 crores of policies today, and your take rate is 13%, you do revenues of 900,000 crores, right? And let's see what they can do, because I don't find a reason why they'll not reach 50, 60, 70,000 crores in next 5-7 years. And then you have to see that if they do 70,000 crores, what is the kind of profits they'll make. But these are very small tracking positions for us. Only
Okay.
price will make us scale up. When we get price action, because I told you, I'm not okay with this growth rate. I need the stock to tell me that I'm right. So even if I'm wrong, I'll lose 10, 20 bips of my portfolio, right? But so you need to make sure that you're in the winning boat. And if this boat, let's say, doesn't do so well, there are signs that when too many people start hating a stock, typically we make the most money. We had a grocery retailer, which we used to own from day one of the fund, right? And everyone would hate it. We made probably a killing, probably a 8-9x from our purchase price, right? And everyone used to say valuation this, that, but number of retail investors have gone higher now in that counter. But yes, now no one speaks about so much about valuation on that counter. That becomes somewhat a problem.
Yeah. So, I mean, we get the data, we have the narrative in the market, and, a lot of times people use the guts as well to take a decision. How do you use, whether one or all of these factors while deciding about investing, or how do you look at that?
See, we are more analytical because our risk is measured, right? Our largest loss of a portfolio stock the largest stock of a portfolio stock has been 1% of our portfolio. That's the largest we have lost on our position ever. So we are very measured and analytical. We are not gut feel investors. I would say gut feel in the sense that even if I'm looking at patterns, we will wait for the patterns and confirmations to happen, then only go in. Because I was a trader, I focus a lot on risk management. And there are a lot of ways to focus on risk management. Some say there is a price. When if price goes down, you cut your position. Some say that if timing is there, you cut your position. Some say that if there is something change of fundamentals, you change your position, right? We do all three, I would say. So we size according if all our things are, and we also size based on how much drawdown we expect in bad times. Okay, so our size is based on how much upside we expect, but largely 75% is based on how much downside we expect in bad times. So like a financial, like no stock in our portfolio goes about 10% weight, right? If I'm buying, let's say, a B2B pharma stock, it'll be 3%, 4% weight. So it depends on, because I know that someday US FDA comes, my stock will go down 25%, right? I'm just giving you an example. So we will not size up that stock to being an 8% weight of our portfolio ever. It's like, that's not, we think in terms of risk, and we think that if we bought it, let's say reasonable or at the start of a trend, or we are very confident in the next 10, 15, 20 quarters will look like hyperscalers, then we'll add our position aggressively. So
what is the tracking position size for you?
Like 1-2% of the portfolio.
Okay.
We don't track, like for a stock to reach tracking position itself, it's done very well. So because we track everything, to be honest. So I track the US markets, I track what is happening in China. And I'm not just saying prices. Tracking prices is easy. Track transcripts, we track like con calls, we track, because it gives us a playing field. We learn a lot of how people there. See, we are a $3 trillion economy, right? And we're moving to, let's say, $6 trillion. And the patterns are exactly the same. You look at any emerging market, like there are only 4 who've gone to that journey. But how at 2000 or how we have performed from $1,000 to $2,000, the correlations are massive. The correlations are massive that FMCG outperformed. Your 2 trillion to 4 trillion, you will see consumer discretionary retail. Now retail can be online retail or offline retail, right? But both will do very well. Today, Amazon does $500 billion of revenues, and Walmart also does $500 billion of revenues, right? These kind, and the patterns are going to be same as we move from $2,000 per capita to 4,000-5,000. Because in India, you have 3-4 kinds of India, right? 70% of India is something else. 1% of India is probably even richer than what US is. So you'll see very decent, like every segment will do very well. You need to choose your horses.
That's true. So I realized that you have got both CFA and CMT certifications, and I know that you started your career as a trader. Do you use technicals still in your portfolio?
I would say the technicals are used more for the risk management part, I would say.
Okay. Okay.
We are strong. We believe in risk management. Okay. If things don't go right, we know how to cut our position sizing wrong. So, but we also divide the portfolio in two parts. Assuming if a consumer company goes down 30%, okay, I'm probably going to buy the dip. Okay, because it's a market leader. You know what happened to VIP, right? Bad times in consumer companies, because they are debt-free companies, the short-term things typically don't impact them. So we might buy a consumer company. But if I have a leveraged company which is going down 30%, and it's part of my emerging monopoly basket, but the markets are not going down 30%. Okay, if the markets are going down and the stock is going down, it's okay. Okay, we might say that it's okay, but if you're going down alone,
that means market is telling you something is happening there,
and something is happening, and you have to listen to the market, because there are old traders and there are bold traders, but there are no old bold traders. You have to respect risk, and there are ways to do it. Some say that for him margin of safety works. For some, it says that, you know what, price risk. You have to have your own risk management, but you have to manage risk, because markets keep changing, right? But you also need to know how to write trends, because whenever we wrote trends, I've never had some guy on CNBC every day or ET or whatever those news channels, nothing against any channel, but on news channels saying that this is expensive, right? I remember in 2011 when HUL was doing a buyback at 600, everyone said, you know what, the stock has gone from 300 to 600, but it was a 10-year breakout, and 10-year breakouts don't finish in 1 year, right? In a large low beta stock, they typically go on. So for that, one has to study history. And then you had your earnings growth also coming in that time. The premiumization game was happening, and HUL margins were increasing. So once you get all these things right, like an APL Apollo in our case did very well for us, right? It's part of our portfolio, not any recommendation, but you had growth coming in, you had market leadership coming there, you had great ROICs of 40-45% coming in. The company went debt free. It went to zero working capital days, near zero working capital days. When you get these kind of changes in balance sheets, it becomes very easy, and you have your risk. You know that if I'm wrong, I have, let's say, 6% allocation, and I lose 20% or 25%, I lose 1.2%. But yeah, so you have to know that, you know what, I'm ready to lose 1% of my portfolio, 1.5% of my portfolio on every transaction. But you should not typically lose more. But you also need to know how to write the trends, because biggest money, and you cannot then listen to saying that this is expensive, this is cheap, because for a stock to go from 10 rupees to 100 rupees, it'll have to get expensive multiple times. But for a stock to come down from 100 to 10 rupees, it'll be cheap at 60, 50. But if the screen is not telling you to buy, okay, don't just buy it. And don't be deep value investors. For every value unlocking, there has to be growth.
Yeah. So, I'm assuming you're bullish, and you know what's happening in India currently, and there are many positive things happening. So when you look at next 10 years, right? I mean, and people talk about cycles and changes and all that. What do you see the next 10 years will look like from the equity markets perspective?
Raj, my understanding is that wherever you find, just when you're looking at stock picking, wherever you find customers loving the product, you just, and you love the product, and you just do small research of, I love this product, odds are you'll beat 80% of fund managers.
I agree with you.
By doing that. Okay. You look at data in the US market, you look at data in the UK market, you don't have to be. So we also have 80% of our portfolio in B2C companies. Only 20% is B2B. You focus on not to do wrong, rather than what to do right. I can tell you, B2G companies or government-owned companies will underperform in a 10-year period. For 1-2 years, they can outperform. In a 10-year period, you ask me, so I'm telling you. B2B companies will underperform that of B2C or B2B. But companies that grow faster than 20-25% will, I with a lot of conviction tell you, will outperform the companies that grow at 5-7%. Companies, but for that 25% growth to happen, the company needs to have an ROIC over 25%. If your growth rate is higher than your ROC, okay, it's a debt trap. Okay, so you will lose money there. So high debt companies, if you just avoid companies who have a debt to equity more than 1, I assure you, not a guarantee, just my own research. These are factors. I told you 3 things that work. Read about market cycles for last 50 years, read about people who made money, and read about factors who make money. Companies who can reinvest at ROIC. Okay, if you're generating cash flows, if you reinvest at all the cash flows, basically continually do capex, will outperform the companies who don't do capex at all, right? So these are some factors that I can tell you. But how about India? India will move from, as I said, 6.5 lakh crores to 17 lakh crores. That's my big picture theory. The largest, there will be some. So in financials, I would say that focus on technology. Companies who create technology. The banks are not about branch banking. That game is over. It's about technology banking, right? Mobile banking. And that's where largest, whoever gets that pie right will create a massive Bajaj Finance kind of returns, because the growth will follow, right? The second part, in technology, have a combination of services and hyperscalers, but size your position up if your price is also showing that you're right? Believe me, you're buying something which is, so this is a marathon, okay? I'm 100% convinced that technology, so consumer tech, will be 20-30% of the market cap. But out of a 42 kilometer marathon, we've reached only 1 kilometer. And we are all trying to pick who's going to be the winner, ye winner hai, this, that. It's okay, because customers have moved there. Where goes the customer, there goes the market cap, right? I can assure you that very large wealth creation will happen in the tech space. Just don't ask me which stocks are right now, because we are also somewhat, so we can size up, down, depending on our conviction that this story is working out as we expected. And that you can see on quarterly growth numbers. Every 90 days, you get data which shows you things are going on track or things are not going on track. So technology. The third, I would say consumer, but the discretionary part of the consumer. And there'll be massive consumer monopolies. Just the size of profit pools are very small. India's largest AC manufacturer makes less than $100 million of profit. The total number of ACs sold in India is 55 lakhs, right? And every house has 2-3 ACs, right? It's not like AC, something else. So the size of profits are very, very, very small right now. Like India's best footwear retailer, or even the brand, we don't have positions there, but I'm just giving you an example, makes profits of $25 million. So the size of profits, like let's say Relaxo, okay, he sells 18 crore shoes. His profits are 250 crores. So the size of profit. And when people say that, you know what, Nike trades at 35 P, boss, Nike makes that kind of money and it's already reached every market, right? So Indians will have that, and if you get growth will create market capitalization. But if you get value and growth, that will also work. But I think biggest losses which I had, this is what I think, where you be in that those medium quality companies who are not market leaders. So there, you know, you have to know how to sell right. And if you don't sell right, then don't try to get into it as well. So
that's a very valid point. Yeah. If you can time it properly, then there's no point even trying that, because those doesn't sustain for a very long period of time. Yeah.
The first 25% is going to go. The last 25% is going to go for sure, right? So you need to know that how big is the middle pie, if the change is big, because see, I've been more on the technical side and I've been on the fundamental side. If the growth is not very large, your stock cannot walk. It's like you will not win. You need growth to win. It's not possible. It's not possible that you'll have multi-bagger returns without growth being there.
We are coming towards the last part of our conversation, and so what advice, I mean, I know you're still very young, but what advice you will give to a 20-year-old self of yours? What do you want to tell them?
Invest in yourself and be passionate about, be passionate, keep learning. Our team, like my team, they've been learning very aggressively. We are here because of them, because of their hard work, and learn about technology. That is where I would say that the one regret I would say I have, that I don't know how to code. That is one probably regret that I have, but everything else. But if you're working hard enough, because I'll be very honest, Raj, till today we work 14 hours every day. It's not just me, my team also. So it's like when you have that kind of passion and you really want to win, it works right. It works right. Yeah. So at 20 years, I would just say that, and also travel a lot, meet a lot of people, know how to speak better. So I went outside to study. Believe me, I don't remember what I studied, not even 1% of what I studied I remember, but what I learned is how to speak to people. And in life, you'll get rejected many times. When I started on my own, when my age was 23, right? 24, when I started my own business, believe me, I got rejected 1,000 times. I've gone to people, I've called more than 10,000 people for our research desk. We started off at the research desk, and then pivoted to the PMS. Called more than 10,000 people, spoke to 10,000 customers. I've met more than 1,000 people individually going to them. So we've done all that, but what you get, a good understanding of my customer. I may be little, if I'm not, no one's best in the market. We try to improve in the market. But a good business needs to have a very strong understanding of his customers. His customers are 80% of the business and his team. If you understand the customer and you understand the team, you're 99% done in business. And in the market, if you understand risk, you understand the trends, you understand fundamentals, and yeah, you're broadly done.
No, that's a great advice. Our show is called Breaking Investment Stereotypes. So any stereotypes you've come across in your life which you want to talk about here?
I can't recollect at the back of my head, but for me, I'll tell you, if I'm not in the trend, it doesn't probably play out as well. So I like this phase that if you be in the trend, manage your risk, but trend of growth has to be followed by a decent companies, decent growth rate. You'll do very well. What investment stereotypes? I don't think you can make big money in just doing value investing. And this is in India, because I failed. So I might be biased, but value investing without a catalyst is not, I don't know, like it doesn't work. So
the tricky part with value investing is actually the terminal value of the enterprise, right? The terminal value may be zero. You don't know, right? So
exactly. So because I lost a lot of my initial money doing value investing. I used to buy those cheap penny stocks, but that's how you learn, right? If you don't lose, and do not believe in anyone who says that he doesn't lose money in the market. If one guy says that he's a genius in the market, you'll have to go down multiple times. Whenever I built a house, some bricks get broken. I be sad, disappointed, but you have to rebuild those bricks again and again. And this every 3-4 years, the market knocks me. This quarter also, the markets have knocked me. I'll be honest. This quarter also, after 12-13 quarters of doing alpha, this is my first quarter where my alphas are basically negative, right? The markets basically slaps me, and every 3-4 years, whenever I reach 100% alpha, I give 10%. This is my own pattern I'm seeing. That market slaps you for every 3-4 years for once, and then you think that, what, where did I screw up? I'm not with the market. And then you rethink, rejig what mistakes, and your own PNL will show you your mistakes. And then you start working again on building the house. But I assure you, the next time, Raj, and also the fact, every 4 years, people say that that you have exactly the same thoughts every 3-4 years, but that's never been the case with me, right? Every 3-4 years, I learn things. What I say today, if I say the exact same things 3 years from today, that means I've not learned anything new from markets, right? There will be things which I will be changing, but that's how markets are. The Amit of 2022 will be very different from is very different from the Amit of 2018. Your way of thinking, your size everything changes, not very much. Some things remain the change, but some things change. I might be speaking about something else which I would have learned, but keep learning. The markets teach you so much every day. And this is what I've seen. Like 2014, I was different. 2010, I think I was different. 2018, I was way different. And today I'm different. But that's the fun part of the journey. And I'll be sad if I'm not different in 2026.
Awesome. No, thanks a lot, Amit. I think it was a great conversation. I really enjoyed the conversation. And thank you so much for coming on the show.
Thank you, Raj. Thank you, everyone who've been able to hear this conversation. Thank you, Raj. Thank you. Bye, guys.
Thank you.